Yeah, hi, my name is Sarnail Singh. I'm the president-elect for CCIM Central Canada chapter and real estate agent with Home Life Maple Leaf. I specialize in real estate buy and sell in and around GTA, and we have sold over 100 million worth of real estate. So today's discussion is in line with various discussion on real estate and businesses buy sell. So thank you for joining us on the new topic of discussion. As you all know, when someone buy a business, there are so many due diligence processes involved. One of them is financial review of business. Now, today's topic is buyer's financial due diligence before buying a business. So if I'm a buyer, I want to buy a business from a financial due diligence perspective, what questions I need to be answered, are the challenges I might face. So I need to know before, these challenges, because if I don't clear myself on these questions, and then eventually I might end up taking a wrong decision. So to discuss this, I have invited Rakesh Majithia, who is CPA and CA, specialized in accounting and assurance and tax services, have offices in Mississauga and Oakville area. So let us welcome our guest, Rakesh. Rakesh, please introduce yourself before we start our question answer session.
Thank you, Sarnail. It's a pleasure to be with you guys here. And we've been practicing accounting, bookkeeping, tax, consulting, and financing services for more than 12 years. As you mentioned, it's from 2 locations, one in Oakville, one in Mississauga. And we have a strong staff of 8+ staff in our team as well there.
Okay, all right. No, good to know, thank you. And so my first question, Rakesh, to you is, what should buyers look for in terms of financial statement when buying a business?
Financial statement is the most important result or a reflection of a business there. Many people do not pay full attention to the financial statement, but it gives a very good picture of how the business is performing. So depending on the industry the business is in, for example, I'll take an example of a retail business. So if the retail business is there, definitely you want to look at certain fundamental things, what cost they have allocated towards lease, what cost they have allocated towards other fixed cost, such as any labor cost as well, which will be, because they'll have fixed number of hours required to be open. Then you also look at the soft costs, such as what the material, so what the products they're reselling, plus any other contracted employees they may have, which are called upon requirement only. Any franchise costs that they may have as well. This will give a good indication on what are the reoccurring regular costs, which will also help a buyer determine how much cash flow will be required in immediate 3 to 6 months period when they take over the business there. If we look at the manufacturing business, on the other hand, definitely gross margin will be a very important factor in the business there. That will be raw material, labor, and overhead. All three costs will be important to determine how they can, whether they'll be able to maintain that, whether they'll need to improve that. And when you look at the balance sheet, the capital assets, and visiting the site, definitely in determining whether the capital asset replacement will be needed to determine whether immediate injection of any additional cash flow will be required after taking over the business. Because if the machinery and equipments are old, they may need to be replaced within 1 or 2 years, or maybe 5 or 10 years there.
Right. Now, but what's the key to a successful business, like from financial due diligence perspective?
I'll say the key to any business from financial perspective is the profitability, because everybody will look at how profitable the business is and whether how genuine those numbers are as well. So when you look at those financial statements, it will definitely give you a very clear picture depending on the industry, whether it's service industry, whether there's manufacturing, whether it's retail, or if it's a franchise, depending on whichever industries you're looking at, every one of them will have a different requirement. For example, if it's a retail, location will definitely help. And when you look at the financial statements as well, the lease cost will definitely help you determine whether it's downtown location is required for such business, or can it be moved to a suburb. Manufacturing business, how their logistics are, how the involvement of the owner is there, where are they sourcing their merchandise. All these factors will definitely help in determining whether it's the right business for the buyer or not.
Right. So, like, depending on the business type, it depends whether you look at the gross margin or you look at the net income, which is before debt, right?
Correct. Yeah.
Okay. Now, how do I determine if if a given business is right for me?
That's very interesting, and this answer to this question will definitely differ from buyer to buyer, because profitability is one thing, but many other factors will be involved in acquiring any business. So, for example, an owner is maybe putting 12 to 16 hours a day, whereas the buyer would want to put only, say, 6 to 8 hours a day to run the same business. They might not be right, or maybe vice versa. So depending on your requirement, it might help you whether it's the right business for you or not. From financial perspective, the profitability will definitely help in how profitable the business is. But again, and depending on the industry, when you look at any retail business, for example, each transaction will help you determine, rather than looking at the financial statement to see how the business, how the crowd is coming in, what are the high peak periods, what are the low periods, and that will help you determine whether this business is right for you or not. And some businesses in retail, maybe long hours are needed, but if you're not inclined towards spending long hours in the business, or having more staff to be open for longer hours, then this may not be the right business for you right? On the other hand, if manufacturing will be maybe more hands-off business, where you can have more employees running the business, and your involvement will be more on sourcing the product, make sure the logistics are there, make sure the machine uptime is adequate, make sure your damage is less. So your involvement is more on at a different level, hands-off as opposed to hands-on.
Right, right. So now, how do I evaluate? So say if a buyer want to buy a business, it it might be a retail or a manufacturing. So how do they do the evaluation for retail versus manufacturing business?
Evaluation wise, basically, again, in manufacturing, again, when they walk in, they will need to determine how much cash flow will be required in terms of operating cash, in terms of any replacement cost, they need to replace the machinery or equipment. Maybe they need 3 to 6 months of working capital to run the business. Do they have that sufficient cash flow from the buyer's perspective to look at it and see if they can additional financing, how they can sustain as well. Financing is very important part of any business as well. When you're taking over, that X percentage you have in your hands, but are you able to get additional financing to put the additional money?
Right. Yeah. Now, but how many years of financials, should a buyer be reviewing? He might have the option to review a 10-year, 5-year. So what do you suggest to the potential buyer that he should be looking at the financials for how many years?
More the better, generally. However, rule of thumb is at least 3 to 5 years of business. Looking at the financials will definitely help determine health of the business. You want to look at the consistency of the profitability, of the margins, of the revenue, as well as how much new capital was injected by the shareholders versus was there any additional requirement over the last 5 years where the owners had to inject additional capital, because shareholders account will tell you that as well. What's the retained earnings of the business has been consistently operating under loss or profitability. And even if there was a loss, why there was a loss. Maybe they're not sourcing the products correctly. Maybe they're not, they're having maybe too many staffs that may not be necessary. So this will definitely help you evaluate, or having 3 to 5 years of financial statement will definitely help you evaluate overall business health.
Right. Now, sometimes there are situations for a potential buyer to buy a business, but then this business maybe a 6 month old. The person who started this business had a different situation when he bought, or when he basically started a new business. After 6 months, things change. Now situation is different. Due to some reason, he want to sell the business. So now in this situation, a buyer don't have access to 3 to 5 years of financials. So what do you do? What he or she do in this situation?
Well, in this case, the biggest thing that one should do is at least go and evaluate the bank statements to see how the business was running, how the cash flow was, inflow and outflow of the cash was happening. Also speak to the owners. So what are the reasons they're stepping out in such a short period of time? Speak to the landlord if the lease can be transferred as well in that such a short time. If there's any penalty, who is going to bear the penalty? And the finance side, do they have that sufficient capital to sustain that? Because if it's such a short time frame, you're looking at, if it's 6 to 8 months or less than a year, you might need some additional working capital while the business is being established there. So you might have some family support as well to help you navigate through the initial years of the business, initial months, maybe even.
Right. So right, yeah. So in short, like, if let's take an example, if we have a business and it's a franchise business, say if it's a KFC and someone is buying a KFC franchise business, he review the financial statement, including the profit and loss statements, the balance sheet and the ledgers. Look at those financials, especially, and that too, with someone who is a certified accountant, who is a CPA and a chartered accountant. Show them and let them review it, and then also look at the POS system, whereby he can look at the sales, what sales are being going on. If it's a franchise, maybe he can get the the sales figure from the franchisor. So there are so many things which he can look at those numbers. Or maybe if it's a manufacturing business and the seller is buying all his material from a supplier, maybe he can look at the the ledgers of the supplier, or if he can ask the supplier. So there are so many ways. So thank you very much. Sorry, you want to add something?
No, so I mean, you definitely touched again, as I initially mentioned, that depending on the industry that you are looking at, if it's a retail business, whether manufacturing, franchise, each business it's not a one method will cut it all, but definitely each business will have its own plus points where you can look at the lease, the franchise, or and in the manufacturing, as you rightfully said, the how much purchases are happening, how much payments are going out to make those purchases. Also, they can look at the HST filing to see how they're filing HST, what are the revenue numbers reflected in the HST filing.
True. Yeah.
What's the WSIB that will indicate how many people are actually working over there as well. So these are all multiple indicators that will help you determine whether it's the right business for you as well or not.
Right. The only way is, I always say to my whenever I deal in a business buy, I always tell my client that you should always go to the chartered accountant, certified accountant, CAs who can help you because they have knowledge and experience. Use them, like any wrong decision. And because once you buy a business, there is no U-turn. You have to live with the business. And then if you have to sell this business after buying 2 or 3 days or a month, you may not get the money you have put in, and it adds to a stigma to the whole process. So thank you very much, Rakesh, for your time, and hope our listeners gain from the conversation. And I will have more topics covering various aspects of due diligence in coming days. So stay tuned. Thanks for watching.
Pleasure.